kick it off. Welcome, everyone, and thank you for being here. Today, we're diving into one of the most foundational topics around token design, and it's often one of the most under-examined also. So we're talking about token allocation, capital allocation, and whether it's funding ecosystem growth or backstopping risk or paying your contributors, incentivizing users, how protocols use their tokens really reveals a lot about their priorities, their culture, and their strategic clarity. So today, we'll explore things like, what does good token-based capital allocation look like? How can protocols avoid wasteful spending while still being aggressive in growth? And what role do token holders, DAOs, and core teams have in this decision-making? So let's jump in. But before that, I'll just ask you guys to present yourselves a little bit.
Hi. Okay, this is on. I'm Mary. I previously worked at Galaxy Digital as a fund of funds investor, and then I worked on ecosystem at an L1 called Celestial Labs. And I'm currently founding a company. We're still in stealth. We emerge soon, but soon TM.
I love it. Hey guys, my name is Edgar. I've been in crypto for over half a decade now, primarily in DeFi, but for the last 4 years, I've been running a co-working experience called Mountain DAO, which focuses on the Solana developer ecosystem. And we recently launched not the first DAO investment fund, but the first futarchy governed DAO investment fund. So we're thinking a lot about capital allocation on our structuring side and on the deployment side.
Yep. Hey guys, my name is Alan. I'm the founder of EVG. We are one of the larger Asia-based Web3 group or developer. Have a couple hundred people between different subsidiaries of ours, ranging from the media business to the license, the fintech business, to the AI labs, to the gaming studios. And we also do a little bit of balance sheet investment into the ecosystem as well. Yeah.
Perfect. So what does capital allocation mean in the context of crypto protocols, and how does it differ from traditional finance? I can start with you.
Well, I think it's a pretty, any particular angle, like when it comes to capital allocations?
So in general, what do you feel like it means in crypto versus traditional finance?
Okay, so I think crypto obviously in TradFi, let's say, or even if you think about just like how traditionally a company or foundation is run, you just need to really care for your P&L and balance sheets. And now you have two balance sheets. You have the cash and you have the tokens, right? I think that's the complexity of it. And then you have a lot more parameter you got to really care for, because whatever decision you make could come back and really backfire at you or at the team or at the investors later on. So I think there's a finite draw in what kind of time you want to spend token, what kind of time you want to spend the cash, and also, like, for example, how you convince your team normally, how to find that balance, right? I think a lot of projects are deciding on the team allocation. There will be just like, okay, C-level 0.5%, team leader 0.25%, and then, but historically, like, as you talk to a lot of founders, they will tell you a lot of lessons they've learned along the way. How do you really tie it to, right? Do you tie it to time-based investing, do you tie it to performance-based investing, or take a kind of like hybrid approach? I think all those things should be taken into account as a part of your strategy, because if you think about traditionally, if you're Facebook in seed round, whatever you kind of make your commitment is not really going to have an impact at your share price until maybe 14, 16 years later. Token tend to be very, very differently, right? It's really going to hit you when you're a Series A, Series B startup, because the moment your token go live, all those decisions you would hope you may be thinking a little bit more carefully with team, with airdrops, with giving to ecosystem partners, and etc. So yeah, I think if you speak to a lot of founders like privately in a room, they will all tell you, I think out of the top 5 mistakes, maybe 3 of them is related to the token allocation generally. And I generally always think that cash should be seen as a like a little bit like cheaper commodity, which is weird to say that because I think that tokens once you make certain commitment, you can really not change it. Cash, actually, a lot of time, like if you don't like a guy, pay the severance, he's gonna, you can get rid of him tomorrow, right? So it's much easier to handle, I think, on the cash side because there's so many existing practice, existing laws you can possibly follow. But I think with token side, it could easily become a mess, right? So that's why I think there has been always this like, paradox. But obviously, it really depends on the startup situation. If you don't have a lot of cash, maybe token is your only way, and like you might not have nearly as much options, right?
So last couple of years, 2 decades almost, there's been like a lot of experiments with how assets accrue value. So, for example, Uniswap is kind of the big bad wolf here, where token holders don't receive any amount of the fee distribution. So holding the token is functionally worthless. You're holding like a worthless governance token. I'm more of the opinion that Uniswap was an early experimenter, and folks only realized that governance tokens didn't perpetually accrue value years later, like years after the token was launched. So I think there's a new shift in aligning incentives entirely. So Morpho, for example, has aligned incentives entirely into a single asset model. So token holders accrue some value from fee distribution. I also think that like private markets were so overskewed over the past couple of years in crypto, just seeing the capital pour into specifically venture funds primarily in 2020 and 2021, that some companies were overvalued to the extent that their revenue will never match the underlying valuation. So now we're left in a market where these tokens will only perpetually go down because no serious financial investor is going to underwrite a token where it's not quite clear how value accrues to the token, and it's 1,000x overvalued based on its current revenue.
Yeah, I think 2 points that you guys mentioned that are really interesting. One, I think over the last few years, there's been a lot of experiments around what does a token mean as an asset? What does it do? And I think largely driven by a lack of regulatory clarity, tokens have been instrumented as this like attempt to be a one-size-fits-all asset, right? Oh, the token's going to be a governance token, and there's going to be some kind of utility, and holders are going to get some special access, and oh, it's also going to accrue value, and oh, it's also going to help us with, capturing distribution. And ultimately, I think empirically we've seen that just hasn't worked, right? I think the future splits into two ways. One, I think we're going to see traditional securities move on chain. And we're starting to see that happen already. Major institutional investors are starting to underwrite proper securities that are going on chain. And these are going to act like traditional equity assets. They're just going to leverage blockchain infrastructure for the logistics of the asset existing. I think the other side, I think is really interesting, is the attention token direction, right? And this one I find is a little bit more controversial now, but in my opinion, it's a clear crypto case study, right? If we look at what tokens have been good at the last few years, it's been capturing attention. In my opinion, right? Tokens are phenomenal distribution assets. This is why meme coins have exploded, right? I think there's a parallel that we're seeing in traditional equity markets. If you were to ask me, hey, Edgar, why do people buy Tesla, right? I would say that primarily at the retail level, it's not for the fundamentals, right? It's because people, maybe they have a Tesla, they're seeing Tesla marketing everywhere, they like Elon, or he's going crazy on Twitter and he's capturing their attention. There's a lot of buying activity, holding activity that is happening from a distribution angle, right? We're seeing Meta, Google start to ship shares with less shareholder rights, right? And they're starting to say, hey guys, look, this is a different type of asset, right? But if you want to be a part of, what we're doing here, here's one option, right? And maybe it's priced differently, but it's an asset that gives you exposure option nonetheless. I think that there's a world where, as we move forward, attention tokens become a really valuable part of crypto. They effectively like meme coins that have a more proper, more scoped down focus, right? Tokens that are, not just about a dog or a cat or something that's like hard to productize, but tokens that are not equity assets, but center around like a meaningful project. So I think that's kind of a really interesting evolution, and I'm excited for, I think, both sides to get more specific and more tangible.
Thank you. And going into allocation mechanisms, what do you think are the pros and cons of using tokens directly versus stablecoins or treasury assets to fund growth or to pay contributors and risk buffers, all of that?
Yeah. So I think I think what Mary mentioned is interesting. I think first of all, if we go back to like the way I kind of see token is there's many different shapes and forms of token. I think what you mentioned is like the very classical Wall Street view about like, hey, if you buy a stock, you're owning a piece of company, you should have value accrual or dividend or some sort. But I also think a lot of times like price is what you pay, value is what you get. A lot of time you think about in the reality world, you can think about a watch as a token, right? A lot of people spend $500,000 on a watch. Is it really for utility? Not necessarily. It's a combination of things. For example, in Hong Kong, we pay $1 million for a club membership, right? US dollar. And so it's like, you really just getting the restaurant? Not really, right? So I think you can really think about token is what I think is a very subjectively perceived value network, right? That's how I would generally classify it. And I think once you get to know that, then you can really design the tokens in like what Edgar said, like many shapes and forms across whatever your project is. Like let's say if you're doing a gaming project, then of course you need a token for part of the usage. For example, you want to actually see maybe your season 3, season 4, if you can almost get to a deflationary level, that is a good measurement of whether your game economy or game loop is actually working. For DeFi, it's going to act very, very differently. It's more fee sharing, it's more different type of mechanics. But fundamentally, I do believe that if we are not using token to align the incentive with the stakeholders, then we are really not playing to the strength of Web3, right? Because I look at token and Web3 is almost like this form of like a stakeholder capitalism where the earliest Uber drivers should be part of the network. They should not own nothing because they are the one that formed the earliest network effect. If you're a banking client, you can forego maybe your dividend, but in exchange for a bigger network giving to the new user so that you can grow your pie together. So the way we look at it is like, if you're not really thinking along the line of stakeholder capitalism, then you are not really having that much advantage compared to the Web2 startups, which can raise more money, have a cleaner balance sheets, maybe have an easier time to get audit, and really, IPO. So I think the importance, if you look at the success of, let's say, Bitcoin, for example, is a perfect example of stakeholder capitalism, right? And I think, I think projects should, at the same time, there's a lot of holes or a lot of traps, or a lot of mistakes you can possibly make, but we also should embrace it, right? And that's why I always encourage like using token regardless, aligning incentive with users, aligning incentive early builders. If you're a chain, for example, aligning that with your team, aligning if you really need that DAO, then for example, align with DAO. But I think fundamentally, I think that is a powerful weapon, and a weapon is no good or bad. It just really depends how you wield it, right? And so fundamentally, I think my overall take, because it's really hard to kind of draw one line for a different type of project, really based on the nature of your project and what kind of layer you're building. But fundamentally, I think you should actively embrace it, because ultimately we are not in the game of trying to say, let's optimize the chance of not going wrong. We are optimizing for the chance to potentially go very, very big, right? So if that's where you want to go, then I think we should definitely try to wield the weapon in the right way, right?
So my big opinion is that tokens the way they've been conceived over the past couple of years are dying. I don't think there's any chance for tokens to continue to be released in the way that like we've seen over the past couple of years. So there's like a couple of examples that I look at. There's the big kind of categorical infrastructure projects. There's this awkward tension right now with proof of stake networks where it just starts to make less and less sense for folks to hold tokens that are kind of like Solana, right? Like Solana has this like cult-like traction, this huge consumer moment and consumer recognition, but there's a diminishing window of infrastructure tokens that actually can replicate the success of Solana. I also look at some projects like Shuffle. So Shuffle is this enormously cash-generating project, and yet their token has more or less stagnated. So their token model is you stake for a shot at their lottery, and it's like, despite being this enormously cash-generating project, the token price has just stagnated. So I'm of the opinion that if you check CoinMarketCap 1 or 2 years from now, number 1 through 50 will probably be tokenized equities like tokenized NVIDIA, tokenized Tesla, instead of the tokens of nebulous projects that we see today. And then to like answer the question in kind of like the current existing status quo of how should tokens be used and delegated to incentivize growth, it's like you have to think of these projects from like, what are they, right? Are they infrastructure projects that are attempting to replicate Solana's success? Are they productive assets, so DeFi products? Well, then for DeFi products like Hyperliquid, it's pretty straightforward, right? You take whatever cash the product actually generates in order to buy back and burn tokens to redistribute value to your token holders. So the token more or less functions as equity. This is also like a very good marketing move that incentivizes like long-term holding and like this deep community support for these types of products. So yeah, I just think that the way that the industry is right now has a very limited runway, and the industry will look entirely different 2 or 3 years from now.
So I agree with a couple points you guys made. I think you want to align value to token holders, for sure. My hot take here is that there's a great tweet I saw a couple weeks ago that said crypto's real PMF is lifestyle. And it really hit me because I think there's a lot of truth to it, right? I think a lot of people are in crypto, and this goes, I think this is relevant outside of crypto. I think this is relevant for tech. I think this is relevant for a lot of industries because people feel at home wherever they are. And that translates to buying activity, that translates to real sustainable value. Solana has a cult community, and I think 75% of the devs that build in Solana are there. 75% of the reason that they're there is purely because they feel at home there, because they love going to the conferences, they love talking to the people. And that translates into products and kind of more traditional value over time. I think we're seeing the same thing with broader tech, right? Look at AI. Who here hasn't heard of Cluely? Does everyone know Cluely? Yeah, everyone's looking at me like, of course we know Cluely, right? Because Cluely is breaking the internet, right? And their distribution first, right? So I think we're seeing a broader shift in companies that has really been highlighted over the last few years, and this is happening in crypto and outside of crypto. You lead with distribution and you back it up with real product, and you need both, right? You need a cult community, you need a lot of conversation to lead, and then you also need to be interesting infrastructure on the back end, right? And if you fail at one or the other, you deal with different problems. You could be a really cool infrastructure project that nobody knows about or nobody cares about, or you could be Cardano, right? So I think a lot of it comes down to what people are actually looking for and what they get value from. And I don't think as an industry we are completely candid with ourselves about where the value comes from.
And just to top up on that question, I think I constantly think that if you read the book like Homo Deus, like it talks about this very interesting concept of like value is super self-identifying. It's like super subjective, right? Like value is not one. So for example, like in the Asian generation, like my mom, my uncle, and every one of them, like they would buy 3 apartments, 5 houses, all that. They would stack up everything, leverage to buy another apartment. Well, clearly they do not need another one, and the yield is terrible, by the way. The yield is like, for example, if you have an apartment in Hong Kong, your yield might be at 1%. That means it's like 20% of what Treasury could possibly offer you, which is like not a rational decisions. What I'm trying to say is like, if you think about like everyone's like purchasing decision or what's happening to you in your life, like it's really most of the things that you perceive as value is not rational. Like you cannot possibly justify paying $2,000 to see one NBA game. You cannot possibly justify why you have to buy 4 bags, 5 clothes in order to maybe get one shot buying a Birkin, right? Like I think most of the things might not be rational. So I think about value the same way as well. Like if you look at the Gen Z today, they don't want to own stocks, right? Like I think 1% of them maybe will have stocks, or 3% of them have stocks. They'd rather have a meme than a stocks, right? So, but I think it's not really about. I think everything is like what you said is like opting for whatever you identify with. So, for example, I grew up as a gamer. And in China, there's this huge industry called 代练. It means like you pay someone to play the game for you. So whenever I'm logged in, I'm like top in my server. So last year I spent about $150,000 just on paying people to play my game. So whenever I logged in, I'm like, people was like, thanks for coming back, right? It doesn't make any sense. But it's just how how fucked up Asian kids are, because we grew up competing on almost every single thing, and this is what we like to do. So I think like when you think about value, I think the most important thing and token allocation is going back to I think what Edgar said is like you need to know your audience super well. You need to know your audience super well, what they want, what kind of thing they perceive as value. If you tell a lot of meme coin people and say, hey, I was with like Norm last night, right? And I was asking Norm, like, how do you think about your new product and everything, new feature? He's a launchpad right now. But he's like, you gotta add this, like turning all this attention into something real, but also not too real. Because if it becomes too real, you lost that meme coin nature. So which is like super interesting because but I think he understands his audience super well, right? He want to keep that part of the meme coin culture in there so it's not completely becoming another utility token or another fee sharing tokens. So I think it's like knowing your audience is probably the first step of the allocation decision because they pretty much pre-decide what works and what don't. Yeah.
So I love the cult-like irrationality of crypto. Like it's a really fun dynamic to play with. But it's not healthy or sustainable, and I think you can see that, especially with like Luna UST's like algorithmic model. It's like, oh, this is dependent on Luna going up forever, right? And all of a sudden, Luna crashes from 110 to a penny, and you can see it right now with Launchcoin. So Believe app, which I love in theory, being able to like fundraise from internet capital markets, but there's no clear definition for the company's coin that's launched from Believe, and there's no clear definition for Launchcoin itself. So you see like a lot of like aggressive community members demanding a flywheel be implemented in Launchcoin, and it's just not healthy for the team and like the token holders of all these like company meme coins that were launched, as well as Launchcoin, like the core products tokens holders as well. So yeah, it's like while like these experiments are like fun and interesting, it's just there are like a number of consumers that get hurt for being the one who believes and holds the token until infinity.
Yeah, I'm going to pick up on that last point. On governance and process, who should actually decide on how tokens get allocated? Is it token holders, core teams, councils? How do you strike that balance?
I think it's a very tricky question. It also depends what kind of stage the project is in and what kind of format is that project, right? And like we can always argue like, hey, if Bitcoin actually has a foundation, Bitcoin might not get to where it gets to today, right? But you can also argue that, hey, if Ethereum has a Tomas figure early on, you might have done better. So you can argue both sides, right? And then obviously you look at a lot of projects that's DAO controlling their treasury or controlling all the fees, and then there's a whole bunch of DAO Nazis and like a lot of mess being created along the way. So I think there's not like one rule, like one thing fit it all kind of like scheme. But I do believe not everybody could be founders. Like I think it's kind of like, I'm not sure if it's hot take, but like I think a lot of people, just because you bought a little bit of a token, you engage it, you yap pretty early on in the Discord, doesn't mean you have the founder vision, or doesn't mean you have the founder greed, right? Or doesn't mean you're willing to stand with the project when it's suffering and struggling, right? When token price is down, like for example, like Luca is a close friend of mine. Like he gave away one of the most generous airdrop, I think, in history. People were happy when the token price was going well. When it's down, like you saw people become super mercenary at the projects, right? And so, like, the other thing is like, did you regret that? If you can go back in time, would you do it differently and stuff like that? But fundamentally, I think he has this founder intuition of like what he tried to achieve is ultimately the largest distribution possible, because he believed the project should not be limited to the 10,000, 30,000 holders of the NFT. They think they should go wide. So this is his founder vision, and he have to bear the cost. He have to pay the cost, right, in playing that playbook. So I think fundamentally, the founder vision, the founder direction cannot be substituted. It's almost like, if you think about it, it's like Singapore. If you talk about a country, for example, right? A lot of people who've been to Singapore, Singapore is pretty tight on a lot of things. If you want to smoke, there's this little yellow box outside of the building. You can only smoke in there, right? You cannot smoke outside of it, otherwise you get fined $200 Singapore dollar for it. For a lot of people, it's like, dude, that's dictatorship. There's no liberty, there's no freedom. And they force each communities to have a ratio of different ethnicities, right? Like you have 30% Malaysian, 40%, 50% Chinese, 20% Indians in each of the hood, so that they can try to eliminate discriminations. Is that a good decision or a bad decision? Very hard to tell. But I think what really makes that unique is that when Lee Kuan Yew was inventing the place, is I have the iron in me to decide. This is the right way to allocate my resources to decide how people live. The key is, does it work? If it worked, then it doesn't matter, right? So I think ultimately I do believe that founders need to be able to call those shots. If you just go with the community all day long, they tend to swing. They tend to swing when the time is good, when the time is bad, then you're going to caught in between. And in the end of the day, you can't please everybody, right? Because you're going to have some good time. Also, you're going to have a lot of shitty times. And in those shitty times, for example, like if you look at recently, every token is down. Everyone's like, tokenomics doesn't work, da-da-da. How much is it really about the project? Maybe 30, 40%. A founder can only control a proportion of the factors. Maybe 60% is what we can control. We can control what Trump is going to tweet during his ballot movement in the morning, right? We can control what Iran's going to do. There's a whole bunch of shit that founder cannot control. We're not superheroes. So ultimately, I think if you think about that, it's like we can't just say, hey, community, whatever they like, let them decide, purely vote for everything, because you might just end up being nowhere, right? So yeah.
I think I'd probably restrict the scope of the question to specifically venture-backed projects that are trying to survive for a decade, 2 decades, minimum 3-5 years of a timeline. And then in terms of allocation, so I'm actually a very big fan of Futarchy. So if you guys are familiar with MetaDAO on Solana, as well as Robin Hanson's paper on Futarchy, I think that is the ideal eventual outcome of when there's more capital allocators in crypto. I think you'll see a lot more participation in governance based on market forces. So governance proposals are voted on by token holders, people with vested interest, and they vote based on what they think is best for the token, the price. So what governance decisions will drive price up? I don't know if you'll correct me later, but
no, you're on track. You're on track.
Yeah, and I think that is kind of the ideal form of governance, is this hybrid between governance driven by market forces and like a small committee, right? Like an external third party that isn't the team, isn't anyone with this like private vested allocation, so that you have like a driven smaller community that decides, is incentivized to actually go into like deep discussion. Because otherwise, you have a Discord server where there's 30,000 voices who maybe do this part-time, right? And if you have like a conversation with some of the original folks in Maker's committee, they're paid more or less like a full-time salary, but they say it's like an 18-hour job of just constantly dealing with squabbling, like internal squabbling. So yeah, I just think like the ideal form of governance is like a smaller committee that decides what to vote on, and then token holders like harnessing market dynamics to decide which governance proposals to actually push through. And governance proposals meaning like a delegation of XYZ tokens to XYZ initiative. Otherwise, you see like a lot of misaligned directives. So Arbitrum's gaming DAO is probably infamous for significant mismanagement of tokens and like token allocation and investments. So, you know, it's going forward, like all of these lessons will compound and hopefully shape into that hybrid approach.
Yeah, I think this is a really great question, and it's very tricky to answer. And I think the answer on how, you know, who should be making decisions, how that should be organized, is very context dependent. And I think we see that with like sovereign countries around the world, right? They're run differently. There are different people around the globe that prefer different structures of governance. I think we are going to have the same thing in crypto. I do think that a republic structure where the DAO is delegating to a small committee of generally full-time or clearly incentivized members tends to make the most sense, right? We ran a really interesting experiment with Mountain Capital. So Mountain Capital is the first futurity-governed investment DAO. And when we launched it, I have a co-founder, right? So there's two of us. We gave ourselves no team allocation, right? So we bought in just like anybody else. And, you know, from a DAO perspective, we were just like anybody else. And day one, everyone was like, all right, Edgar, what are we doing? And I was like, that's not my job, right? Like, I helped set things up, then I bought in just like you guys. Like, what do you think we should be doing, right? And it was a really interesting exercise in, you know, in an industry where people are often, you know, arguing for more agency when they don't have it, to see how many people did not want agency when they were given it, right? And where the DAO conversation has gotten to now is, you know, kind of towards this republic structure, right? Where the DAO said, all right, well, it feels like we should have somebody that, you know, kind of focuses on this, right? Okay, how are we going to do it? Okay, let's figure out how to hire people full time. Let's figure out how long their term is going to be. And that seems to be the way that it's going. But I think it's really fascinating that, you know, there's very clearly not one objective right answer here.
Yeah, we don't have a lot of time. I feel like this has went by really fast, and we could spend a whole day talking about this. So maybe I'll finish with a little bit of a hot topic. Is it ever justified for protocols to burn tokens or do token buybacks purely to protect token holder value?
Do you want to go with that first?
So the question is it ever okay to buy back tokens for...
To burn tokens or buy back tokens to protect token holder value? For token not to go down?
I see token buyback and burns as a marketing move. And I think it's a marketing move that can be used really intelligently because it shows confidence in your token. You see like all these like VC projects over the past couple of years, all they do is sell their token, right? Like who wants to hold that? I don't want to hold that, and I would never hold that. It's like when I see a project buying back their token, it's like, oh, there's this very intentional redistribution of value back into like the token holders' hands. So instead of like manifesting a community for your exit liquidity, you're actually growing alongside your community.
I think it's also the clearest path towards value accrual that works across all types of tokens, right? So in a world where we have equity tokens, this works. In a world where we have attention tokens, this also works, right? And this is, we were talking earlier about where does Web3 have an edge against Web2? It's way easier to buy back tokens in Web3 than it is to buy back equity in Web2, like even just logistically, right? And so I think I'd love to hear the argument against buyback and burns, because I think it's one of the best strategies we have right now.
Yeah, I think if you look at traditionally all the tech company when they buy back token, doesn't matter, it's Google, Facebook, Tencent, whatever, they buy back token, they don't necessarily burn it because they can actually dividend, right? Because they're actually registered as security, so they don't have to do this kind of like interesting financial engineering thing. A lot of shares they bought back will be on their balance sheet as treasury stock, and then that's where it is given to the talents when they join the company, right? Like, hey, here is your RSU for the next 4 years. Here's a refresher in year 2. Here's a refresher in year 4. So that's how they continue to attract talents. And but I think there's no, again, like this is, I think the main thing is like, I think I get why people really like the buyback or burn situation, because it's a signal to tell people, it's like, hey, my project actually has sustainability. We can feed ourselves. So we're not the marginal seller, actually is on the other side with actual revenue that can continue to allow us to compound the growth. And so I guess it's more like a confidence thing. Does that mean every single project should do it, or how meaningful that should be? Should we evaluate that as the only way to look at like, should we just because Hyperliquid is hot, right? Let's be honest, right? Like, does that mean every project need to be Hyperliquid, right? Like, or does every project could generate $70 million every month? Not necessarily. So I think it's obviously a very good mechanism. We're thinking a lot for that for some of our product, probably not other product. We're also thinking like, for example, you can also have this other take of like, let's say if you're like an L1 token or like as a gas tokens, if you're a chain, then technically you might, even you have, let's say $100 million, $200 million gas fee a year, you might not want your price to go up that much, because as a gas token, maybe not going up that much is a better thing as well, right? It depends how you really, really want to decide that. But fundamentally, I think, is certainly the appetite for the current climate. So seems like there's a trend going on, right?
Okay, before we wrap it up, if you could give one piece of advice to protocols trying to use tokens more wisely, what would it be?
I don't know. I can use some advice myself. I'm not sure if I can give advice. I think, but if you speak to a lot of founders that's launched the token, I think everyone has a couple of skeletons in their closet. They've all faced all sort of demons, things that they might want to do differently. Funny things. I think some of this, like, because, I talk a lot with my founder peers, and when we are private, when there's no investor in the room, we actually can talk pretty candidly. Some of the mistake A made is exactly what B was trying to recorrect from. So sometimes, like, it's really, really hard to say. But I think generally, what I would think of the rule of thumb is just don't be very cautious of using token to buy traction. I think if you look at Web 2, right? I think one of my favorite saying, especially about like if you think about consumer products, the best consumer product at the first 2 rounds or so almost never grow because they spend the money on programmatic ads. You think about most of the successful product, they grow through product iterations. And then they get to a point of virality because the user really love it and they tell a lot of people. You see Brian Chesky saying a lot about how Airbnb was in the early days. That was exactly how Tencent was built. That's exactly how many of this great product was built. So I think a lot of projects last year, I think if you look just broadly as the mistake is everyone is trying to use the token expectation as like, hey, you can go 10 times from here to buy enough tractions in order to maybe enhance the shot of getting listed. And if we kind of keep it real, the problem of last cycle or last year or so is the listing slot being greatly compressed. That's what every project, every protocol kind of face as an issue. Compared to 4 years ago, we have hundreds of slots being listed in Tier 1 exchange. Last year, we have maybe 1/3 of that or 25% of that. So everyone was like, hey, I got to rush. And it's also partially, I think, the issue of some of their investors as well. The investors are, you got to go fast, right? Give me some DPI, give me some markup so I can go out raise another fund, right? And so I think everyone is using token a little bit too much to try to buy tractions. And it will almost guarantee to backfire because the real users, now it's going to come down below every single studios. Right? All the studios is going to win. And like I have a lot of, obviously look at the studio, there's a lot of Russians in there, there's a lot of Chinese in there. There's a lot of my friends making a lot of money through this systematic way of playing the game. But I think that is like generally the common mistake you see across all projects was just this like very not precise airdrop format. Because like you could be airdrop to every single wallet, but maybe if you're a DeFi project, maybe only 20% of those users are actually DeFi users. So how do you know actually you're incentivizing the right guy? So I think, just be cautious around, or maybe ask them to prove their identity before you start giving them certain things, right? Okay, you want to tell me you're a worthwhile address, you're telling me you're worthwhile of these things, prove to me what you have done before in other chains, other products, or certain things. So I think, yeah, if you eliminate that, that probably save you already like a large percentage of the marginal sell pressure, as Mary mentioned.
Yeah, my advice is don't launch a token, because I've been talking with some friends, and it's like the clear observation right now is that if you don't have a token, well, then you're on track to be a acquisition target at a premium. Whereas if you have a token, you're suffering, and your token price is just constantly sinking. And then if you do launch a token, make sure you're fee-generating product before you launch a token, because it gives a lot more versatility and agency to decide what to do and how to grow the token on a longer-term scale.
I'll keep it short. I think there's a lot of value to launching a token. I think it is a brutal experience. But if you do it right, that's where the opportunity is. I think that right now, in the last 7 years, this is the best time that I've ever seen to explore tokens, to launch tokens. I think we're moving towards regulatory clarity, especially in the Western world, especially driven by the US, right? We're in the great city of New York. So I think now is the most attractive time to go down these routes, despite the trade-offs.
Perfect. Thank you so much.
Thank you.